AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
No, welcome back.
Welcome back.
And I'm Gordon Hines. We're here every Thursday from 6 to 7, the Drive Time Special.
Gordon Hines, the Mr. 80-20% guy. Well, we're going to talk about that later, and we're also going to talk about some of his left-hand, right-hand philosophy. I think you'll find it entertaining to hear some of his insights on that. But we are a real estate show. We're here to inform, educate, and participate. You can call the show 800-516-1220, 800-516-1220, or email the show Tony or Gordon at BayAreaLoanSource.com. Gordon's been doing everything. He's been in real estate for 25 years plus, everything from renovations, property management, commercial, mortgage origination, real estate transactions, resales, which a lot of people know as flips. You probably do 2 to 4 year. I've been in credit and loan financing for at least 17, 18 years. So you're talking to two professionals right here. You're welcome to send us the emails with any of your scenarios. This is what we do. We like to give you second opinions, and we love to hear what everybody's doing out there in the marketplace, which we always find quite interesting. And we get stumped at least once a week, Gordon, with something crazy. We had a guy who called today. He wanted to do yesterday, but he sent us some information today on a loan modification he did. He's probably listening. He's a listener of the show, and he did a loan modification 3 or 4 years ago, and he did something called a shared equity modification. A lot of people who did a modification may have or may not have been offered this option, but he was modified for the next 18 years at a 2.07% interest rate fixed on like a $300,000 balance. And isn't that crazy? But he has to share equity of the future value of the property up to a certain amount. So he's really scared that he was going to give up a large, and it's 25% of the equity, but it was limited. So he got kind of scared, but he actually turned out to have a good modification. But these are some of the scenarios that we like seeing. And it turns out that he doesn't need to refinance because he's limited on, there's nothing to hedge in the future except that balloon payment, which is 17, 18 years from now.
Yeah, I've seen many versions of the modification. Some good, some not so good. I've seen the deferred balances, as you just mentioned before, where they kind of take the amount that you owe outstanding if you were behind, set it aside, and so you pay this back in X amount of time. I've seen where all balances were forgiven, principal were forgiven, and this is the first time I've seen this one here with the shared equity position, which is kind of interesting. But I guess what the lender said, okay, here's what you owe us. We're going to put this aside. We're going to share in your appreciation by reducing your rate for X period of time. If you sell, there's one option. If you refinance, there's an option. So it's kind of interesting. But at the end of the day, I think the key thing is the homeowner was able to keep his home. So it was a blessing.
Ultimately, a good modification, and we like those kind of scenarios. Anytime you guys want to send it, it's Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. So I was wrong last week. I thought rates were going to go up. I kind of said, we're going to see rates over 4%. I was wrong. Rates never made it past 4%, according to Freddie Mac. They're now sitting about 2-week lows. 30-year fixed at 3.94%. The 15-year is at 3.27%. And the 5-year ARM at 3.23%. All great rates. And there's a good chance I never try to predict rates again, Gordon.
Good. You're not a good predictor. That's what
I'm not
I
a good
always tell
predictor.
people. You don't predict if you have a targeted rate or targeted payment in mind. Always lock that rate. If I was a predictor and I had a crystal ball, I probably won't be on this show. I'll probably be on national television doing some type of prediction. But I always tell people, hey, listen, the market's always up and down. It has trends. What we try to do is kind of follow the trends and kind of say, now is a good time to lock. I can never guarantee that I'm going to lock at the lowest possible rate. Just like in the stock market, I can never guarantee you can buy the stock at the lowest and sell it at the highest. That's the way I kind of see it in our business the same way.
I see it as if I do it 9 out of 10 times, I'm going to be wrong. That one time I'm going to be right. I'll be that one guy.
Well, you know my rule. I'm the 80-20 rule. If I can be accurate 80% of the time, I'm winning.
Okay, I think it's time to get into this conversation here. You say that people are they're accurate at what they do, or they're proficient at what they do 80% of the time, and 20% of the time they're not.
No, that's not. I said if you can be proficient at 80% at the time, you're winning. That's a model of success. Probably the average is probably around 59, 41, somewhere in that ballpark.
It's my opinion. Okay, so it's my opinion that no matter what you're doing at any point in time, you're doing 100% of whatever you can do. So there's no 80-20 rule. You're always doing 100% of what you can at any point in time.
But your accuracy at what you're doing is what I'm talking about.
No, but if you're not accurate, it's because you're doing what you could do at that time. It could be anything from throwing a disc or a javelin, or
if I can throw it straight 80% at 100% of the time that I throw it, I'm winning.
You can kind of understand how this is frustrating. You're 100. I believe that no matter what you're doing at any point in time, you're doing
right. You're going to throw the ball 10 times, which is 100%, and I'm going to throw it 10 times, but I'm going to throw it 8 times accurate. So I'm 80% accurate out of the 100 times, over the 10 times I throw it.
But those 2 times that you didn't throw it accurately, there could have been something that created the reason why you didn't throw it accurately, and that's 100% of what you could have done at that moment.
I call that margin of error.
Margin error, okay. We're going to talk about non-qualified mortgages, and there's a big reason we're talking about that today, because it is a huge part of the market, and it's continued growing. Inventory is tight, which is, according to National Association, is pushing up home prices again. In fact, the Case-Shiller report came out today, and they showed a 6.1% year-over-year increase, which is up from last year. So they're seeing stronger growth in home prices. Rent growth is slowing a little bit. We're going to talk about 1031 exchanges. Seattle's on the map. They're saying that Seattle's home price growth is bigger than the Bay Area. Amazon is building their second headquarters somewhere in the United States. They have a list of 15 cities. I think it's really interesting. We're going to talk about what effect that Amazon will have on that city as far as rents are concerned. And that's kind of a play into whether or not you want to be a landlord in one of these cities. They are going to eventually find some place soon, and it's going to take 2 or 3 years to build this place, and they're predicting some major increases in rents. And then what states are people moving in and out of? I think a lot of this has to do with, what are the trends in the United States? As an investor, a lot of people I think the Bay Area might be played out. I want to buy a house to live here, but there's just not enough inventory. There's too much demand. I'm going over asking price. Why can't I go to a place like Seattle or Reno's or Salt Lake City's, Denver's, Colorado, the Texas, which leads the nation in people who want to stay in the state. 93% of the people looking for mortgages are looking in the state, and then you got New Hampshire, where like 57%, or it's even higher than that, I think, that when they're searching for a mortgage are looking out of the state. What are your thoughts?
Probably the number one state's probably Puerto Rico. That's what I heard this morning. Puerto Ricans are leaving Puerto Rico like wildfire, not just because of the natural disaster we just had, but because of the economy, because of the whole infrastructure. Puerto Rico, it's almost like taxation without representation. They don't really have an eye in Congress. They really can't vote, but they're still considered to be U.S. citizens. So Puerto Rico needs some help.
So qualified mortgages, and you can call the show 800-516-1220, 800-516-1220, or what they call non-qualified mortgages. A qualified mortgage it's a category of loans that have certain or stable features that help it make it more likely that you'll be able to afford the loan. This is one of the criteria of getting a qualified mortgage. And a lender must make some sort of good faith effort to determine that you have the ability to repay your mortgage before they can sell it. And these are typically Fannie Mae, Freddie Mac, FHA, VA, USDA, and jumbo loans. A non-qualified loan, it's not necessarily the opposite of a qualified mortgage. It just doesn't quite fit that qualified mortgage standards or their complicated guidelines. Another term that might be associated with where a lot of people have heard about non-qualified mortgages is portfolio loans. And it's a loan that's kept with an investor and it's not sold. So they're a bit riskier, and the rates can be a little bit higher, and you have looser guidelines, but not necessarily meaning it's an easier loan. So you just have to fit into that box. There's so many products that are useful, Gordon, and I know you've used these before, and I know that we've done these a lot of them for clients. Interest-only loans. So qualified mortgages, they're gone. Interest-only loans are gone for the majority for all qualified. You can use them for non-qualified mortgages. And when we're working with a client right now, and here's some of the advantage of using an interest-only loan. He has a 3-unit building, and he owes about $900,000 on it, which is conforming, which means he could have easily gone to Fannie Mae, but Fannie Mae doesn't have an interest only. And the difference on this payment could be up to about $1,000 a month. if he does the interest only. So he's betting on here that the value will increase, but his cash flow won't if he just sticks with principal and interest. So he wants the extra cash flow, $1,000 a month or $12,000 a year. What do you think of that?
Well, the most important thing, and people invest in real estate, especially multifamily, is cash flow. You're not investing to house families. That's what nonprofits do. You invest for cash flow. So anytime an astute investor can increase his cash flow with an interest-only loan or a short-term fixed rate, most investors are going to take that because their whole portfolio is balanced on cash flow, not on appreciation. That's the best way to take a look at it.
So another non-qualified mortgage would be they go over 80% value on cash out loans. All right. So if you have in this case, you have that 3-unit building. Let's say you're taking cash out of it on a refinance. They're going to Fannie Mae, Freddie Mac, FHA, VA, and so on are going to limit you on how much cash you can take out. With non-qualified mortgage, the limits are still restricted by and heavily influenced by your credit score, but you can go up to 95% cash out, up to $2.5 million. Believe it or not, these mortgages do exist, even with the interest only, even on a 40-year term in some cases, and even on like a 4-unit building. So you have this advantage of cash out limits as well with non-qualified mortgage, and you also have no mortgage insurance with any of these products. You can even go over 80%. In almost every case that you get a loan over 80%, you're either doing mortgage insurance, you're doing lender-paid mortgage insurance, or you're getting a second loan. Otherwise, you have to put more money down or have more equity. So these non-qualified mortgages actually have no mortgage insurance on it. So you can go up to that 95% cash out loan with interest only and not pay mortgage insurance. And mortgage insurance typically equals about 1% in rate, that payment. So if you can get a 5% rate on a cash out 3-unit building, that really equates to up to 95%. That really equates out to about 4%. So you're all of a sudden beating the rates that you can get on a standard transaction. So these are some of the things that we like talking about with these non-qualified mortgages.
Well, I think the best difference I can explain between a qualified mortgage and a non-qualified mortgage, there is no third-party representation in a non-qualified mortgage. There's no investor guidelines. Everything is up to the person or the institution that's lending you the money. Where at a qualified mortgage, there's Fannie Mae, there's Freddie Mac, there's government regulations, there's Dodd-Frank, there's HUD, there's VA,
and so on, yeah.
And all those intermediate third parties that are supposed to bring about better consumer quality of loans are in qualified mortgage. And a non-qualified mortgage, grandpa can open up a shop on the corner and start lending money in a non-qualified basis, make up his own guidelines as long as they're legal. As long as they're legal, as long as they're fair, and everybody can apply, and that's considered to be a non-qualified mortgage, something that's outside of the parameters of any outside regulatory company or institution looking at it. That's the biggest difference.
We definitely have some more to go over when we come back after this break. The non-qualified mortgage is a growing part of the industry right now. It's because we're going to talk about self-employed borrowers, bank statement products, no income, no asset products. These are products that are hitting the market by storm. We're here to inform you. We'll come back after this break here on AM 1220 KDW. You can always hit our website, BayAreaLoanSource.com. You can always call the show, 800-516-1220.
On AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show, 800-516-1220. Email the show, Tony@BayAreaLoanSource.com. So we were talking about non-qualified mortgages. And the reason why, Gordon has a great saying. What's your saying? Products drive.
Right. The products drive the market, not interest rates. So the reason why our market has greatly improved in the last 24 months is because of more and more products. The more confidence that consumers get with the marketplace, the more the loans perform. Investors now are beginning to become a little bit more aggressive and offering more loan products, which drive the market even further.
I was reading an article, Gordon, before the show, and it was talking about how it's like, the hardest part about finding a non-qualified mortgage loan, and we'll just call them portfolio loans. It's a lot easier. A portfolio loan is finding the lender. You can find these portfolio lenders pretty much. They're like non-bank lenders, but even banks are coming out with these types of loans. So we're brokerage, so we have multiple sources is. Anyways, some of the products we talked about was interest only, cash out to high limits, no mortgage insurance. The one I bought too is for people who've had credit events, foreclosures, short sales, bankruptcies, loan modifications, things like that. The wait periods can be a lot shorter as well. So if you, let's say you're in an emergency situation and you have to sell, instead of selling your house or going into foreclosure or something like that, you can, and you need the money out, or you need to refinance or buy a house for that reason, or for that matter. They have shorter wait periods for people who've been in these situations. There's also something called another portfolio loan, NINA. It's called No Income, No Assets. As crazy as it sounds, they are here. It's a side effect of an improving market. Why else would they offer a product like this where you're not proving income, you're not proving assets, you are proving equity? You have to have at least, 35% equity on these products, and the rate's going to be higher, but you're getting a loan. That's another product that's out there. Bank statement loans. I know you've done several of these. These are hit and miss. They're not quite perfect yet. They're getting a little more traction right now. It's specifically made for a loan for somebody who's self-employed that has a lot of write-offs where their net income is suffering. But under the bank statement program, you use deposits to source your income. You can use personal statements or business statements, not both. And where this is where it gets sticky, though, and no one really plans to have to use one of these products. They hope that their net income is going to be sufficient. So what happens is the bank statements, they're not consistent, and that's usually what we see. We see inconsistent deposits. We see a lot of people deposit in their personal account, and then they move money over to the business, or they do business into their personal, and they get it all mixed up. So this is the type of loan, Gordon, that you definitely want to plan in advance. And unfortunately, they go back 2 years. So again, nobody plans 2 years in advance on some sort of self-employed income that they need bank statements to get a loan.
Well, I mean, a few.
What about the 12-month bank statement programs?
A few of the programs that I've done, that you have the option of 12 months or 24 months. The difference between the two options is the 12-month option of the bank statements. The guidelines are a little bit tighter, and also the rate's higher because it's more risk involved. On the 24 months, you typically get a better rate at a cheaper cost. That's the difference. Typically, they go off of a 24-month average, the deposits only, no transfers, no rollovers, no transfer between accounts, strictly deposits added up, divide by 24, and that's the number that we come up with to assign you for your income. So if you have 24 months of bank statements and the average deposits are $120,000 divided by 24 months, whatever that number is, if it's $8,000 a month, that's the income we're going to use to actually qualify you for that loan.
So non-qualified mortgages or portfolio loans are there. Some of the other features, you can do 40-year terms, stated incomes, higher debt ratios. They go up to 55% on these products. Foreign nationals. ARMs are very common. They also can have prepayment penalties and balloon payments. My thought about non-qualified mortgages is you have to have an exit strategy because 6 out of 10 self-employed borrowers are using these types of products, Gordon.
Yeah, I've got a client right now, and a good thing you mentioned the exit strategy. This particular investor has a ranch that he has a loan on. He has a first, second, and third. He has a great loan on the first. He has a great loan on the second because an equity line is tied to the first. He needed to muster up some cash about 2 years ago. He got a short-term loan for 2 years for like $400,000, and that note has now become due and payable. He doesn't quite have enough time to go out and get a new loan and refinance the whole thing. So he's actually now going to take another qualified mortgage to pay that loan off in order to satisfy the terms of that particular investor. So they're flexible loans. This loan is actually going in the third position. There's a lot of equity in the property. It's a great property. And these are the kind of things that the investors, the private people do that the traditional institutional lenders won't do. And that's the reason why these loans are so popular.
Highly recommend that you do your planning when you get that exit strategy. If you use like a self-employed product or a bank statement product, you start working on how to get into that standard Fannie Mae, Freddie Mac, FHA, VA, USDA loan because that's really the ultimate goal because they have the best rates. The harder the loan, the lower the rates. The easier the loan, the higher the rates. Always remember that. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report. You can always go to our website, BayAreaLoanSource.com for more info.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Welcome to call the show, 800-516-1220, 800-516-1220. Email the show, Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. Some economic news out there. Who's this from? The Housing Report from the National Association of Realtors. Home prices, both nationally and in most major metropolitan areas, grew substantially in the third quarter of 2017. They said tight inventory kept home prices rising at a steady clip, while it also pinched sales growth. The median price nationally of existing single-family homes in the third quarter was $254,000. That's up 5.3% from the same period of 2016. And the second quarter year-over-year gain was 6.1%. So it slowed down a little bit, but the 6.1 came back from Case-Shiller as well. So we're seeing not really that much conflicting news. I like the Case-Shiller a little bit better than the National Association of Realtors because it also comes with some predictions. National Association of Realtors tracked prices in 177 metropolitan areas. Prices in 162 of them, 92%, showed increases in the third quarter compared to 93% a year earlier, and 15 MSAs, metropolitan statistical areas, recorded lower median prices year over year. Lawrence Yun, the chief economist at the National Association of Realtors, calls housing performance in the third quarter underwhelming. Do you agree with that?
I don't have an opinion.
No opinion. He says the stock market's climbed to new record highs. The continued stretch of outstanding job growth and mortgage rates under 4% kept home buying demand at a very robust level throughout the summer. Unfortunately, the pace of new listing homes were unable to replace what was quickly sold. Home shoppers had little to choose from. That is a problem. And many had to outbid others in order to close on homes. We all know about that here. The end result, and this is spreading. I think the story here is that this is spreading everywhere. The end result was a slowdown in sales from earlier in the year. Steadfast price growth and weakening affordability continues. Affordability is an issue. Inventory is an issue. Overbidding is an issue, or competing issue. So it's a tight market, Gordon. And so is this just going to continue playing out that the rich can buy homes and the average homeowner is going to be suffering? And then, the people who can't afford a house are just going to sit in the sidelines and keep watching while they're paying higher rents?
Well, as you know, I'm not a fan of prediction, but we all know that at some point in time, stock market, real estate market, there will be a break in the market. As what I do predict in the real estate market, at least, we won't have that slam like we had back in 2007. Hopefully we have a soft landing, because going back to the earlier topic we talked about qualified mortgages. Everybody's in a home today is actually qualified. So if something does happen in the marketplace, we're not going to have these massive foreclosures. There are a lot of different things that goes on in the marketplace that changes the opinion of the marketplace. I think in order for us to have a dramatic change, as we talked 2 weeks ago, there has to be something catastrophic that's happened in the marketplace that would really influence something, that a huge turn down in which we start to spiral down. And we can never plan for those events, but I don't see any of those events kind of happening, because everything that kind of pops up, we've been able to deal with. The market's been able to weather, and the market might dip for a couple of days, but it goes right back up to where it was in previous sessions. So
wait, when you say that, though, do you think that we're betting on the low inventory to continue pushing home prices? You think that's what people are betting on right now?
Well, it's not that people are betting on it. It's a reality.
Well, they wouldn't be betting on it if they wouldn't be betting on housing if they thought it was going lower.
But it's not a bet, because people don't buy homes to bet. People buy homes to live in. So the challenges, of course, when you get into a market like this, if people want to retire, the problem is, where did they retire to? It's very difficult to scale down in our marketplace. You can't sell your 4-bedroom house and try to go to a 2-bedroom house, because you're going to pay almost the same price that what you sold your house for.
So there's the whole, we're locked into our inventory in some cases.
It's challenging. So we just have to kind of work through it, and as more and more homes get built, if you look at housing starts are up, and these are all things that are going to affect the future market of our marketplace. I was mentioned earlier that one of the things that Donald Trump has done, he's been true to his game. Everything that he predicted he's going to try to do, he's making a lot of changes. And today it looks like he's going to replace Janet Yellen, who was the Fed chair that we thought we were going to be for another term. But it looks like he's got somebody.
That's another shakeup.
And we don't know which direction this person is going to take the marketplace. That's all. And these kind of changes do affect the market, so things can look like it's steady, but a new person comes in, new sheriff in town, and it could go a different way than we planned.
We'll come right back after this break here on AM 1220 KDOW. You can call the show 800-516-1220, 800-516-1220. We'll be right back here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us this hour. We've talked qualified mortgages, non-qualified mortgages. We've talked about the Fed. We've talked about interest rates. We've talked about home prices, slower growth according to National Association of Realtors, but it's Case-Shiller has it picking up, and they show a nice prediction for next year. So a lot of people are looking to figure out where to buy. In fact, Gordon, I'm going to give you a choice of what stories to talk about here. You want to talk about how to do 1031 exchanges, which is, I think, a fantastic story. Okay, shaking your head. Seattle's home prices are rising faster than San Francisco's, a report says. Seattle metro home values rose more than 12% year over year over the last 12 months. Which states do homeowners want to buy in and move to and from? And Amazon's headquarters, number 2, may increase rents in 15 cities. Which one do you want to talk about?
Well, I like Amazon because if you look at any city, there are many cities that are vying to get Amazon to move their second headquarters into. Any city that lands that particular company, the amount of employment they're going to bring to that city is going to be really good for a tax base for that city. The question is like the NFL stadiums, how much does the city have to leverage to land that employer of Amazon to come into your city? Sometimes you might give up too much and not get the return like you do. Like we did a story a few years back about cities that leverage themselves to build NFL or professional stadiums. It doesn't pencil out for the city. The owner wins, not the city. But they sell it to the city as if they're bringing all these jobs and they're bringing all this tax revenue. The jobs that those stadiums bring are part-time jobs with minimum wage jobs, very few high-paying full-time jobs. So it doesn't really pencil out. So cities got to keep that in mind, that they don't leverage a farm to try to land that big employer such as Amazon.
They are offering massive incentives to try to get Amazon to land in their cities. San Jose, Los Angeles, Denver, Dallas, Austin, Minneapolis, Chicago, Detroit, Pittsburgh, Boston, Philly, Baltimore, Washington, D.C., Raleigh, and Atlanta. I don't know. I think Raleigh's got some fantastic. Raleigh's looking really good. In fact, they're on the top of the list as far as Apartment List. It's an online search company and research company. They analyzed what would happen to the rents in these cities. For example, San Jose. Their annual growth would increase. Well, right now, our annual growth in rents are 5.1%. They're saying an additional annual rent increase with a headquarters in this city would be 1 to 1.6%. But Raleigh looks like it would grow 1.5 to 2% on top of their 3.2%. So a city like Raleigh, which already has affordable housing, which is one of Amazon's first and most important criteria. That city's going to see some amazing returns. How do you play this as an investor? Obviously you wait to find out where they're going to build, but you're not going to go and buy a house in 15 of these cities. Would you consider buying it in maybe 3 of them?
Well, I mean,
or would you just wait?
I think you have to wait, because the problem is if you remember when the Raiders were, I don't know if you were here, the Raiders were looking to move down to Southern California into this place called Irwindale. And it was announced many people ran down to Irwindale, which was a deserted city right outside of, San Bernardino, bought up land, bought up places, and the stadium never got built, and those people lost their shirt, and the Raiders came back to Oakland. So I think you got to wait and see. I think, unless you have an inside job or an inside track, or you have somebody who knows what's going to happen predictably, you can actually hurt yourself by trying to predict what the actual company's going to actually do.
There's definitely some incentive there. We've seen what happened in Reno, for example. Reno's seen the highest median home price they've ever seen. They've also seen record-breaking vacancies for rentals, and they've seen the lowest amount of listings ever in the market, which everybody knows the whole story about it, and supply and demand. Because of Tesla and some of the other companies that have moved there, and they're saying more are moving there. I researched Triangle in Raleigh. I like Raleigh. I think Austin and San Antonio have a good chance at it as well. I really like the fact that 93% of the people looking for mortgages in Texas are looking to buy in Texas. So I think there's some homegrown attitude there. I kind of like that statistic. I would wait.
I would wait. If I was a betting man, I think one of the major cities is going to end it, because one of the key things about a company like Amazon, they rely on highly skilled labor. They don't require a minimum wage job. So they have to go to a city that has a great pool of highly skilled labor. New York City is going to be right up there in the running. I know Austin, Texas has a lot of high-skilled labor too, so that's something that they really have to consider of future employment, the labor pool to pull from rather than having to import employees at additional cost to the company.
So you follow, as an investor, would you follow trends like Seattle's home prices are rising faster than San Francisco? They're hitting new highs. According to Zillow, median home value in San Francisco is $865,000. But the last, and then you look at a place like Everett, Bellevue, Tacoma, all these places are starting to look at like 455. That's up 12.4% over the last year, topping their list of fastest appreciating markets. Do you follow that as an investor?
Well, I think,
meaning follow the inventory and the home price appreciation and go there and say, you know what, all I got to do is buy a house. I might look at 10, 15% return, and I maybe cash flow on a property and then sell it after a few years after things cool off.
It's very difficult to manage properties from a long distance location. I think a lot of times what ends up happening is the financial sheet, the fiscal sheet, your planning sheet, it always performs better than the actual cost, because when you invest long term, long distance, long arm statutes, as they say in law, it costs you so much extra to do a small thing. I think you were going up to Reno to take care of a problem with your property, driving 2.5 hours up to go to take care of a property. That additional cost sometimes doesn't really pan out from investors.
I think you're giving me credit on how fast I drive. 2.5 sounds a little short.
Well, that's why you got that new Tesla, right?
No. Yeah, so there is some value in having a property close by. It's funny that lenders are really looking closely at people who are looking to buy rental properties close to where they already live, which is funny because you're like, I want to buy a rental property very close to where I live so I can manage it on my own. And then the lender goes, we need you to prove that you're actually moving into this house because we don't think that we don't think you're moving into it. So there are some challenges that lenders have to get through. Lenders are not common sense, right? Underwriters are like the platypus of the finance world.
Very few things in life are common sense.
With that said, you're always welcome to shoot us an email, Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. And you can visit our website, BayAreaLoanSource.com. Call the show 800-516-1220. We'll come back after this break on AM 1220 KDOW. This is Tony Mendez and Gordon Hines. This is the Real Estate Report.
Is Money 2.0 on AM 1220 KDOW.
Come with me now. Come with me now.
Welcome back into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
You can always reach us at 800-516-1220. We are live, and we are talking real estate. A little bit of mortgages in there as well. We kind of had a topic, 1031 exchanges. That's kind of picking up. I think that's more of like an investor show that we should do. 1031 exchange, it's like you're deferring your taxes. It's from 1984. You got to identify if you want to exchange asset from one like property to another. It's not as simple as that. You can actually take four different properties and do it into one, or you can do one into four. So there's a lot of different things you can do. I think it's where maybe we'll just get our
the problem I have with 1031 exchange, that program needs to be updated. It's not enough time for an investor to identify a property and close a deal within the time that's allotted for that product. In this marketplace where it's such low inventory, you go out there and get stuck selling your property, trying to identify and buy one. You're going to make a bad decision. You might as well just sell the property and pay the taxes. Problem with these program, a lot of government programs, they never update themselves to current day issues, and that's the reason why it's behind the times.
So the other topic we were talking about was, and I agree with you, it does need some updating. We'll get our 1031 guy on the air pretty soon. Where are people buying and where are people looking to buy? What states are people leaving? Vermont, they have the highest rate of people looking for mortgages out of the state. 76% of locals were looking for out of state. And Texas, 92.5% are looking for potential mortgages in the state. So those are some interesting stats. California was on that list as well. They're pretty. I can't remember what it was that percentage, but it's pretty high.
Well, I came across this tidbit. What does this mean to you, Tony? But behind every dark cloud, there's a silver lining. What does that mean to you?
There's a I don't know. It means anything you want it to mean.
I came across a great
light at the end of the tunnel. What do you want to call it?
Light at the end is a good analogy. California, we're going to have a building boom because of the wildfires. In Sonoma, Napa County, they lost over 2,000 structures.
It was 8,000.
At 8,000, massive opportunity to rebuild. The great thing, that part of the community is an affluent community. It's the wine country. There's not a lot of undeserved or unprivileged areas in that particular environment. You're going to see massive home building. You're going to see a lot of great appreciation. Jobs, as President Obama used to always preach about. So that's why I say behind every dark cloud is a silver lining. So I'm glad to see that's going to happen. The same thing is probably going to happen in Houston. Houston, congratulations to the Houston Astros, first World Series ever winning the World Series. That city now, that they needed that type of bus, that kind of robust. They can have a great parade. All brings dollars and things back to that city that's so badly needed after that storm.
I was kind of torn on who I wanted to win on that.
I was definitely rooting for the Dodgers.
Yeah, I mean, going to California to win. They've won before. You kind of root for the underdog in this case, or the one that you think might deserve it more. And good for Houston. That's an interesting real estate market on its own. But very devastated by that hurricane. We like the fact that they raised tons and tons of money for that city.
Yeah, one of the professional football players there has been raising. I think he raised almost $10 million. JJ Watt, $10 million for hurricane relief, which is actually a great thing. So there's a professional sport person that's doing well for himself and also for his community by getting awareness out and raising money for his city. So
the Federal Reserve declined to raise interest rates at its policy meeting this week and said that late summer hurricanes, speaking of hurricanes, likely will not have much long-term impact on all economic activity. As widely anticipated, the Fed Open Market Committee, the central bank's policy arm, held its benchmark interest rate between 1 and 1.25%. They kind of kept their language alive for what they think is going to happen in December. So we could see an interest rate hike in December unless something changes. What do you think, Gordon?
As we talked earlier, as I mentioned earlier, it looks like we're going to have a changing of the guard. So with the change in the guard, we might see some changes. I can't call it, but I think we're going to have a bang-buster year. Don't forget to turn your clocks back on Sunday. Daylight savings time picks up. I hate when it comes this time. It gets dark too early. We'll be doing shows in the dark again, Tony.
Thanks for joining us. We'll come back next week. You can always visit our website, BayAreaLoanSource.com. You can always email us, Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. Thanks for joining us here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. And this is the Real Estate Report.